With earnings season kicking off on Friday, will it be the catalyst to push the markets back to new highs? Let's bring in Mark Luschini, Chief Investment Strategist with Janney, Montgomery, Scott, and David Sowerby, Managing Director and Portfolio Manager with Ancora Advisors. David, good to have you in the house.
Welcome to the house.
In the house with the claret jug.
With the claret jug.
With the claret jug.
Could your Monday be any
Couldn't
better?
be any better.
Does that make you feel more positive about the stock market here?
A lot of smiles
Yes,
from the
What is
three anchors.
what is the message of the markets to you these recent days? What is the market telling us?
You start off with the tug of war. I think tariffs are going to win in the near term in the tug of war. Over the weekend, you add up all of the announced tariffs. Either we're imposing.
But they don't seem to be winning now. I mean, the market's up 300 points today. It was up a lot last week.
Sure, but let's look at it this way. It's $150 billion. It has the potential to offset about half of the positive impacts of the tax cuts, throw in higher gas prices, and that's where you become a little more worrisome. And if we just quickly break down this administration, let's call it Trump Act 1. Tax cuts, deregulation, stocks rally 30% from the November 2016 elections. Trump Act 2, since he started talking about tariffs in late January, the market's down 4 or 5%. The average stock is more than 10% off its 52-week high. I like Trump Act 1. Trump Act 2 in claret jug terms, double bogey.
All right. Mark Luschini, your thoughts. What's the market saying to us?
Well, Tyler, I think it is being very schizophrenic. I mean, we saw behavior basically over the month of June that I think was symmetrical with regard to the activity in the market translating from what sentiment was as it related to concerns around trade, already decelerating global economic growth, particularly outside the United States, and what could be amplified as a consequence of a trade war. And so you saw a rotation into those defensive bond surrogate sectors. So far last week, more toward the end of last week on Friday's Goldilocks jobs report, and today you're seeing a reversal of that trade. Now, whether it's any more than a counter-trend rally for the cyclical trade, and it is going to peter out here sooner rather than later, or whether, in fact, like you had mentioned, Tyler, it's earnings season that will, in fact, reestablish a new higher floor for the stock market upon which it can build, is going to be predicated upon the delivery of those corporate profits, which are expected to be up something on the order of 20% on a year-over-year basis. If the surprises come in and even mount gains over and above that, it might, for the moment, pull back investor concerns that perhaps, yes, we've seen the peak in earnings last quarter, but it's not decelerating to the extent that the market needs to worry about it at this juncture.
At what point, David, do you take a look around the world and see what the impact? I mean, our markets have sort of absorbed this idea of a trade dispute or trade war in kind, and we're sort of bumping along here. We're doing all right. But around the world, we're seeing stock markets that are reacting much more dramatically. Take, for instance, in China, where the Shanghai Composite's in bear market territory. At what point do you say, you know what, it's dinging global growth to the point where the U.S. should be concerned?
I think the U.S. should already be concerned.
Okay.
There's nothing good that comes out of tariff talk. Nothing good. It's nothing more than indirect tax on us as consumers. It raises prices. It's going to slow down the economy. We've learned that time and time again. And Trump gets a B+ when it comes to tax cuts and deregulation. He gets a D when it comes to trade. So it will slow down our growth rates. Margins are peaking. We are going to have a great quarter with earnings up 20%. Margins still very healthy. But I think the next iteration is going to be slower growth on the U.S., particularly if these tariffs unfold. So how do you quickly play it? Maybe you buy more U.S. small caps. Avaya out of bankruptcy. Hamilton Beach, not just simply blenders, but many other products that are growing their free cash flow. So in addition to the large caps where you can still own a Boeing, I think you want to own more small caps in this type of market space.
What about you, Mark? I mean, I find it interesting today, if we're talking about trade versus earnings, trade represented by a couple of Dow components, Caterpillar and Boeing, which are both doing very well today. But the financials that are reporting earnings later this week, JP Morgan and Goldman Sachs, they're both doing very well today. Do you like those sectors, or what do you do right now?
Well, I like the latter more than the former, Bill. I think you're getting, again, that kind of trade risk off trade manifesting in the rally we're seeing in things like Boeing and Caterpillar, which have suffered under it for so long. On the other hand, you have financials as a sector that are trading cheaply on an absolute basis, 12 times earnings, not just on a relative to the market basis, that have really underperformed quite dramatically relative to most sectors, if not all, so far this year. And so you're, I think, seeing a setup where if there's going to be a rotation into what has lagged financials and what what can help the market. Financials representing about 14% of the S&P 500 that have been reporting good earnings and are expected to again this quarter. We just saw the Wall Street Journal article this morning that talked about loan growth at a 5.5% pace on a year-over-year versus where we were at the beginning of the year, which was negligible. That's indicative of commercial and industrial activity picking up on the back of business spending, which I think is a setup for the financials to perform well, which is why we believe that's a sector in which one wants to be a participant in, particularly the banks, the regional banks, over the remainder of this year.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.